private credit is a ticking time bomb and nobody's talking about it. Imagine waking up tomorrow to headlines screaming financial collapse incoming. The biggest investors in the world, Blackstone, Apollo, and KKR, are pouring billions into private credit, yet you probably know nothing about it. What if I told you that this hidden market controls $2 trillion and could be the next financial disaster, or the biggest wealth opportunity of our generation? But here's the thing, most people have no idea what's coming. And that's why you're here. Welcome to the Profit Report, your financial headquarters. Private credit is a $2 trillion market, growing faster than nearly every other asset class in finance. But here's the problem. Most people have no idea how it works, why it's growing so fast, or what risks are lurking beneath the surface. For decades, when businesses needed loans, they went to banks. Whether it was a startup looking for funding or a major corporation needing capital for expansion, the traditional path was through financial institutions like JP Morgan, Bank of America, or Citibank. But after the 2008 financial crisis, everything changed. Banks became more risk-averse, enforcing stricter lending policies that cut off access to capital for many borrowers. This left a massive gap in the market, a gap that private lenders rushed in to fill. These non-bank lenders, including hedge funds, private equity firms, and specialized investment groups, began issuing loans directly to companies, bypassing banks entirely. At first, private credit was seen as a niche high-risk alternative, used primarily by companies that couldn't get traditional financing. But today, it has exploded into a mainstream investment vehicle. Some of the largest institutions in the world, Apollo, Blackstone, KKR, are pouring billions into private credit. Even sovereign wealth funds and pension funds are betting big on this space, seeing it as a high-return, low-volatility asset class. And yet the average investor barely understands it. Private credit now funds everything from real estate developments to leveraged buyouts, but because these deals happen behind closed doors, outside of public markets, there's very little regulation, oversight, or transparency. So while the wealthy are quietly cashing in, everyday investors are left in the dark with no idea if this is the future of finance or the next major financial catastrophe. So the big questions remain, what exactly is private credit? Why is it growing so fast? And more importantly, is this the key to financial growth or a ticking time bomb waiting to explode? Private credit isn't just growing, it's reshaping the entire financial system. Right now, some of the biggest players in finance are shifting their strategies. Banks are struggling, interest rates are high, and traditional lending is tightening. But private credit? It's booming. Apollo just raised over $15 billion for private credit investments. Blackstone is calling it one of the biggest opportunities in decades. KKR recently expanded its private lending division, betting billions on direct loans. And here's the kicker. This isn't just for Wall Street elites anymore. New investment platforms are making private credit accessible to regular investors, meaning the rules of the game are changing fast, but with great opportunity comes great risk. There's a reason private credit has remained in the shadows for so long. Unlike publicly traded assets like stocks or bonds, private credit deals happen behind closed doors with little oversight, no daily pricing, and minimal transparency. The question is, should you be getting in before it's too late? Or is this a bubble ready to burst, just like the subprime mortgage crisis of 2008? In the next few minutes we'll break it all down, how private credit works, who's making money, and whether it's the next big financial opportunity or a hidden risk that could shake the entire economy. To truly understand private credit, we need to break it down into three key areas: what it is and how it works, who is profiting from it, and what risks you need to watch out for. What is private credit and how does it work? Private credit, also known as direct lending, refers to non-bank institutions lending money directly to businesses, individuals, or real estate developers. Unlike traditional bank loans, these loans don't rely on deposits or the Federal Reserve's monetary system. They are financed entirely by private investors, hedge funds, and private equity firms. In simple terms, private credit is lending without banks. A business needs funding, but banks won't lend. Instead, a private lender steps in and offers the capital, often at a higher interest rate but with more flexible terms. The lender earns steady, predictable returns, while the borrower gains access to capital they otherwise couldn't get. This model exploded in popularity after 2008, when banks started imposing strict lending regulations. And now, with interest rates at multi-decade highs, private credit has become an even more attractive option for businesses looking to borrow. Who is profiting from private credit? The biggest winners in the private credit boom are major investment firms, private equity giants, and hedge funds. Blackstone, KKR, Apollo, and Ares Management have all raised billions in private lending capital over the last few years. Institutional investors like pension funds and sovereign wealth funds are using private credit to generate higher returns than they'd get from traditional fixed income investments. Even retail investors are starting to get access through platforms like Yield Street, Fundrise, and new fintech lending platforms. In fact, Warren Buffett himself has made strategic moves into private credit, calling it one of the most promising areas of finance in the coming decade. Why? Because private credit offers higher yields than traditional bonds, more stability than public stock markets, and direct access to business and real estate lending deals. But with great rewards come even greater risks. The hidden dangers of private credit are significant. Private credit operates outside of traditional banking regulations. This means less oversight from the Federal Reserve or SEC, no government bailouts if things go wrong, and limited transparency on how these deals are structured. And here's the biggest red flag. Many private credit lenders are now offering riskier and riskier loans, just like what happened before the 2008 financial crisis. Some are lending to highly leveraged companies that might not be able to repay. Others are loosening underwriting standards, allowing borrowers to take on more debt than they can handle. There's also concern that private credit firms aren't disclosing their true financial exposure, since these deals are done behind closed doors instead of in the public markets. This is exactly how the subprime mortgage crisis began. The question now is, are we heading for another financial meltdown, or is private credit a once-in-a-lifetime investment opportunity? Let's go deeper. Now that we understand the explosive growth of private credit, let's talk about the part no one likes to discuss: the hidden dangers, potential failures, and systemic risks that could trigger a financial meltdown. Because while private credit has created massive opportunities, it also comes with serious challenges that most investors don't fully grasp. The biggest issue? Private credit thrives on high-risk lending. Many of these loans go to companies that traditional banks won't touch because their debt levels are too high or their business models are unstable. Since private lenders operate outside of regulatory oversight, there's no clear picture of how much total debt is floating around and how much risk is actually in the system. This is exactly what happened in 2008. Leading up to the financial crisis, banks were handing out mortgages to borrowers who couldn't afford them, packaging them into opaque investment products and assuming that everything would keep growing. Today, we're seeing a similar pattern in private credit. The loans are getting bigger, the borrowers are riskier, and if the economy slows down, defaults could skyrocket. The big question: how much of this debt is actually stable? Unlike stocks and bonds, private credit doesn't trade on public markets. If you buy a stock and decide you don't like it, you can sell it instantly. If you hold a bond, you can cash out or trade it. But in private credit, you're locked in. Private credit loans are illiquid, meaning that once money is tied up in a loan, it stays there for years. If a recession hits, investors can't just pull their money out. And that's exactly how financial collapses start, when investors panic and try to exit all at once, but there's no way out. Private credit is often called shadow banking because it operates in the dark. No FDIC insurance, no Federal Reserve safety net, no government oversight. And yet private credit firms are now lending at levels that rival the biggest banks. This means one thing: if private credit firms overextend themselves and borrowers start defaulting, the consequences could be massive, potentially triggering a financial crisis that spreads through the global economy. Even the Federal Reserve and the SEC have started raising alarms about the growing risks in private credit markets, but with so much money at stake, no one is slowing down. With interest rates at 20-year highs, borrowers who took out private credit loans at lower rates years ago are now struggling to keep up with their payments. This is creating a ticking debt crisis where some businesses will default, lenders may not get repaid, and investors could lose millions, if not billions. The worst part? no one knows how bad it will get. Unlike traditional banks that report their financials publicly, private credit firms don't disclose how many of their loans are actually at risk. It's a black box of hidden debt, and when things go wrong, it will happen fast. So, are we on the brink of another crisis? Some experts say yes. Private credit is following the same pattern as the subprime mortgage crisis before 2008. Others believe that private credit is simply replacing traditional banks and the system will adapt without major disruption. But one thing is clear, private credit is now too big to ignore. If it crashes, the impact will be massive. If it thrives, it could redefine the future of finance. The question is, what happens next? In the next part of this video, we'll break down who wins if private credit keeps growing, who loses if the market collapses, and how you can protect yourself before it's too late. At this point, you understand the stakes. Private credit has exploded into a $2 trillion powerhouse, reshaping finance, replacing banks, and quietly changing the global economy. But the question remains, what happens next, and how does this affect you? Right now, we are staring at two possible futures, and the consequences of each are massive. Let's break it down. In this future, private credit doesn't collapse, it takes over. Traditional banks continue losing market share, weighed down by regulations, while private lenders step in and dominate. Corporations, real estate developers, and even small businesses rely on private credit for financing instead of the banking system. Retail investors get access to institutional-level deals, opening up high-yield lending opportunities that were once reserved for billionaires. If this happens, private credit could become the backbone of modern finance, offering higher returns, more direct lending options, and more flexibility than traditional banks ever could. The winners? Private lenders and investment firms, wealthy investors who got in early, high net worth individuals using private credit to grow their wealth. The losers? Traditional banks that failed to adapt, small investors who ignored private credit, borrowers who took on too much high-interest debt and couldn't pay it back. If private credit stabilizes, adapts, and grows, we could see an entirely new financial ecosystem emerge, one that operates outside traditional banking, giving more power to investors and less power to the Fed and Wall Street. But there's a second future, one that looks a lot darker. This is the nightmare scenario. Private lenders overextend themselves, just like banks did in 2008. Borrowers start defaulting on their loans, triggering a chain reaction of financial collapses. Lenders, unable to recover their investments, start failing, one after another. Here's why this could happen. Many private credit deals are built on shaky foundations, loans given to highly leveraged companies or real estate developers who may not survive a downturn. The system is unregulated, meaning no government safety net. If things go wrong, there's no bailout, no rescue plan, and no clear way to stop a crisis. If panic spreads, investors could rush to pull out their money, but because private credit is illiquid, they can't. The result? A massive market correction, a wave of defaults, and a potential economic shockwave that could spread beyond private credit, hitting real estate, stocks, and even global markets. The winners? Those who saw the collapse coming and positioned themselves accordingly. Investors who held safer assets and avoided over-leveraged credit deals. Opportunists ready to buy assets at bargain prices during the crash. The losers? Private lenders stuck with bad loans. Investors who blindly trusted the market without understanding the risks. Borrowers who took on too much high-interest private credit debt and couldn't pay it back. The scary part? Both of these futures are possible. Right now the financial world is holding its breath, watching private credit carefully, waiting for the next move. So where does this leave you? Whether private credit booms or busts, one thing is certain, this financial shift is happening with or without you. So how do you prepare? Understand where the money is flowing, track the biggest players in private credit. What are Apollo, Blackstone, and KKR doing? Watch how institutional investors are shifting their portfolios. Are they increasing or reducing exposure? Look at risk versus reward. Not all private credit investments are equal. Some offer strong returns with stable cash flow, while others are loaded with hidden risks. The key: don't chase yield blindly. Be aware of liquidity traps. If you invest in private credit, understand the lockup periods and exit strategies. Unlike stocks, you can't just sell private credit assets overnight. Prepare for both outcomes. If private credit thrives, position yourself to take advantage of high-yield opportunities. If it collapses, hold cash reserves and stay ready to invest when markets correct. This is the biggest financial shift in decades, and the ones who prepare now will be the ones who profit later. The final question is, are you paying attention? Because in the next section, we're diving into the breaking point, the moment private credit could collapse, the indicators to watch, and what it will mean for the entire financial world. Are we standing at the edge of a massive economic shift? Let's find out. Everything we've covered so far has led to this moment. Right now, private credit is at a crossroads, and the next few years will determine whether it survives and thrives or collapses under its own weight. So what could trigger a crisis? A wave of corporate defaults. Many private credit loans go to high-risk borrowers. If the economy slows down, businesses will start defaulting, leaving lenders with billions in unpaid debt. Liquidity freezes. Unlike stocks, private credit investments are locked up for years. If a crisis hits and investors panic, they won't be able to pull their money out. This could trigger a credit freeze, making borrowing even harder. The debt bubble bursts. Private credit has been growing too fast, too aggressively. If lenders have taken on too much risk, we could see a domino effect. One major failure leading to another, spreading across financial markets. Regulators and economists are already warning about this, but with so much money at stake, no one wants to slow down. So what happens next? Will private credit become the new foundation of finance? Or will it collapse under its own weight, just like subprime mortgages did in 2008? In the next section, we reveal the opportunities that still exist, the safe paths forward, and how to position yourself before it's too late. The future of finance is changing. Are you ready? Despite the risks, private credit remains one of the most profitable and fastest-growing financial sectors. While some see danger, others see a massive wealth-building opportunity. So, how can smart investors take advantage of this shift without getting burned? Institutional investors are all in. The biggest players in finance, Blackstone, Apollo, KKR, Ares Management, aren't just investing in private credit, they're doubling down. Why? Because private credit offers higher, more stable returns than stocks or bonds, less volatility compared to public markets, and control over loan terms, making it more flexible than traditional debt investing. This means that while the risks exist, the upside is undeniable. For years, private credit was reserved for billionaires and hedge funds. But today, fintech platforms and investment funds are making it more accessible. Some of the ways individual investors can get involved include private credit ETFs and mutual funds, managed portfolios that invest in diversified private credit deals. Alternative investment platforms like Yield Street and Fundrise. These allow retail investors to participate in private lending deals. Private lending funds. Some hedge funds and investment firms now offer structured products designed for accredited investors. If you're considering private credit, caution is key. Diversify. Never put all your capital into one lending deal or platform. Spread your risk. Understand liquidity. Unlike stocks, private credit investments lock up capital for years. Make sure you won't need fast access to your funds. Stick with high-quality borrowers. Avoid high-risk, highly leveraged companies that might struggle to repay loans in an economic downturn. Private credit isn't going away, it's growing. The question is, will you ignore it? Or will you take the time to understand how this financial shift could work for you? The next section will show you how this could reshape the future of finance and what steps to take next. Private credit has already changed finance and its impact is growing. Banks are losing market share, forcing them to adapt or risk irrelevance. Investors are waking up to new opportunities with private credit offering high yields and alternative funding channels. Regulators are paying attention, hinting that oversight may increase if risks continue to grow. For now, private credit remains one of the most powerful high-stakes areas in finance. The question isn't whether it will shape the future, it's whether you'll be prepared for what comes next. In the next section, we look at what investors should do now to stay ahead. The rise of private credit signals a fundamental shift in finance, one that's already affecting banks, businesses, and investors worldwide. For everyday investors, this is both an opportunity and a warning. The opportunity: private credit offers higher returns and a new way to generate wealth outside of traditional markets. The warning: hidden risks, lack of liquidity, and growing market instability mean that not every private credit deal is safe. Smart investors aren't just watching from the sidelines, they're learning, adapting, and making informed decisions about how to position themselves. The next few years will determine whether private credit is the future of lending, or another financial crisis in the making. The key is to stay informed, stay cautious, and stay ahead. In the next section, we reveal the new financial strategies that could protect you from risk and position you for growth. Understanding private credit isn't just about keeping up with trends, it's about seeing the bigger picture of where finance is headed. For those who take the time to learn, a new world of high-yield investments opens up. Opportunities once reserved for institutions become accessible. A shift away from traditional banking allows more control over capital. For those who ignore it, they risk being left behind as finance evolves. They may unknowingly hold assets exposed to private credit risks. They could miss out on wealth-building strategies that the ultra-rich are already using. The financial landscape has changed forever, and those who understand private credit will be better positioned to navigate uncertainty, capitalize on opportunities, and protect their investments. The final section will leave you with a clear roadmap for what to do next. The rise of private credit is one of the biggest financial shifts of our time. It's creating massive opportunities for those who understand it, but also serious risks for those who ignore it. The key takeaway? Knowledge is power. If private credit thrives, early investors will reap the benefits. If it collapses, those who prepared will protect their wealth. Either way, the financial world is changing, and fast. You now have a deeper understanding of private credit, how it works, where it's headed, and what it means for you. The next step, stay informed, keep learning, and don't get caught off guard. The only question left is, are you ready for what comes next? In the final section, we'll give you one simple action to take today to stay ahead of the curve. Now that you understand the power and risks of private credit, it's time to see how the biggest players are using it to their advantage. One firm is leading the charge, Apollo. They've built a private credit empire that's disrupting traditional banking, and their latest fund is being called a hidden gold mine. So if you want to know how Apollo is making billions in private credit and why banks don't want you to see this, watch this next video now.